Hello everyone, welcome to the analyst classroom. Today we are going to discuss about the non-current liabilities, means long-term liabilities of the companies. So there are main three types of long-term liabilities. First one is the bond liabilities. In the bond, there is the three types of bond: discount bond, par bond, and the premium bond. Then comes the lease. Lease is divided into the short term lease and the long term lease. And then comes the pension also divided into the two categories: defined contribution plan and defined benefit plans. So in this first part of these non-current long-term liabilities, we are going to discuss all the detail uh, discussion about the bond, and I will make a second part of this lecture about leases and the pension. So let's start the bond. So accounting for bond liabilities. So accounting: market value of a bond is present value of future cash flow discounted at the current YTM. Means if you want to calculate the market value of the bond, you need to calculate the present value of a future cash flow and discounted at the current at YTM of that particular time. Okay, and if you want to calculate the book value of that bond, so for the book value of the bond liability is calculated at the present value of the future cash flow discounted at YTM at the date of the issuance. Means book value is calculated at the YTM at the date of the issuance. Let's understand more deeply with this example. For example, for example, I issue bond worth of 1,000 face value. 10% is the coupon rate. Maturity is the 4 year. So my YTM I have cal- so the YTM is 15% on the issuance, 12% on the first, 6% on the second, 4 is on 3, and 2 is on 4th year. This is the way for very much fluctuation. This type of fluctuation don't generally happen, but this is for the just for the sake of understanding. Okay, so if I want to calculate the market value, so what the market value definition says that you need to calculate the future cash flow discounted at the current YTM. So we need to calculate the market value on the current value of that particular year. So if I want to calculate the market value on the date of issuance, so I will calculate by putting the face value 1,000 on the Texas calculator. Payment 10%, 100 is my payment, 4 is N, 15 is I1, compute PV. You will get the 857. The next year, 3 is N and 12 is IY. I will get the PV of 951, and respectively you could calculate for the year 2, 3 and 4. For the book value definition says that the YTM at the date of the issuance, book value discounted, future cash flow discounted at the YTM at the issuance. So I need to calculate at the 15% for every year. So my first year would be the same. My face value is 1,000. Coupon is 100. Maturity is 4. IY is 15, compute present value 857. Second year only change the uh, n to 4 to 3. 3 is n, compute PV. Then n is to compute PV, and respectively for 3 and 4. Your all the other data will remain same for the book value. Okay, so now let's talk about the type of bonds. So there are two types of bond: discount bond, par bond, and the premium bond. So this is the direction of the how liabilities will go upward, sideways, or downwards based on this arrows. You could understand more easily with these arrow directions. For example, discount bond liability will increase over time, par bond liabilities will be remain same, and premium bond liabilities will decline every year. We'll understand this by the example below. So what the premium bond means? Premium bond means coupon rate will be higher than the YTM. YTM. Then the par bond means coupon rate and YTM both will be the same. Discount bond means my coupon rate is will be the lesser than the YTM. Okay, so let's understand with the example. For example, this is the par bond example. I have issued the bond worth of 1,000. Coupon is 100. YTM is also Y. Coupon is 10%. YTM is also 10. Maturity is 4 years. My book value will be the same, 1,000 is my book value, bank balance sheet liabilities. Book liability will be the 100 because my cash outflow and YTM is the same. If you want to calculate face value 100, face value 1,000, payment 100, maturity 4 year, n is 4, payment 100, compute present value will remain same for the all year. Your coupon cash outflow will be minus 100 for every year, and interest expense also would be the 100. Now let's check the discount bond. Face value 1,000, coupon 10%, YTM is 25%, maturity is 4. So if you want to check here, let's calculate the uh, book liability at the issuance. My face value is 100, n is 4, YTM is means IY is 25%, compute present value, you will get the 645. Then put n as 3, compute PV, you will get the 707, and respectively for the other shares also. How would you calculate the interest expense? Interest expense means coupon paid plus increasing or decreasing in the liabilities of that bond. Means I have liabilities of 645 on the issuance, and uh, my liabilities of the bond payment principal is increased to 707. So this increase in the liabilities is also my interest expense. So my interest expense will be 162. My interest cash outflow will be 100 for the all the years, and my interest expense will be interest interest cash outflow plus my increase in the bond liabilities every year. That's how your book liability of 645 will become 1000 at the maturity. So your liabilities of the bond payment is increasing every year. In the reverse case, premium bond, I have issued the face value 1000 bond, coupon rate 10%, YTM is 4, and N is also 4. My book liability will be 1 to 1217 at the issuance. How? Second clear TVM LVA, always do second clear TVM, face value 1000, 10%, 100 is payment, N is 4, IY is 4%, and compute PV you will get the 1217. For the second year, N is 3, compute present value you will get the 1166 for respective for the next years. So in this example, your book liability is decreasing every year. Means you are paying back your principal of bond in the coupon in the coupon. Means your coupon expense is 100 for every year, but in this 100 you are including 57 rupees of the your liabilities of bond. So your bond liability will decrease to 1000 at the maturity by paying back your principal also in the coupon. So in this example, your book liability will decrease over time in the premium bond. And the YTM means investor always earn YTM if he holds till maturity. Means bondholder always earn YTM, not the coupon rate. Here he gets the 10% of the 10% of the face value 100, but he's not earning actual 10%. He's earning only 4%. His 10% is on, if you calculate, is 10% on the 1000, but he has paid 1217. So 100 on the 1217 would be 4% only. Here it's earning 25%. He's only getting cash of 10, but here he's added the remaining amount on the principal. So bondholder will always earn YTM. Now let's check the difference between the two. This in the discount bond liability will increase every year. Premium bond liabilities will decrease every year. Interest expense increases every year and interest expense decreases every year. And this is the interest expense decreasing, this is the interest expense increasing. Interest calculation will be opening liability multiplied by YTM on the issuance. Opening liability, opening liability and YTM at the issuance. And another method is coupon paid plus amortization of the discount. This is the 157 coupon. This is 162 is amortization of the discount. And here also the first one is the same, opening liability multiplied by YTM and the issuance. Here coupon paid minus amortization of the premium. So coupon paid is 157 is amortization of the principal. Here coupon paid will be the less than the interest paid, because interest paid will be including the increase in the bond principal, bond liability. Here coupon paid will be the greater than the interest expense, because here they will pay back the bond liability and will decrease the interest expense. Now next, the initial recognition and initial measurement and subsequent of bonds. So coupon P is cash outflow from the CFO under the US GAAP and CFOs or the CFF under the FRS. And bond issue proceeds are considered as cash inflow from the CFF. Bond issue money will be considered as the cash flow from financing. Here is the effective interest method we have discussed about in the this discount bond minus coupon discount amortize, premium bond minus premium amortize, and opening liability multiplied by YTM at the issuance. Now let's discuss the issuance cost. So under the US GAAP, issuance cost are capitalized as an asset as a deferred charges and allocated to the income statement as an expense over the term of the bond. Under the US GAAP, initial bond liabilities on the balance sheet is reduced by the amount of the issuance cost, increasing the bond's effective interest rate. In effect, issuance costs are treated as amortized discount. Means US GAAP companies are creating the separate deferred charge asset on the balance sheet to amortize over time, and in the US GAAP they are just reducing their liabilities by the issuance cost, and then they will increase over time, let's understand with the example. For example, I have issued the 1,000 rupees of bond, issuance cost is 5. Under the US GAAP, balance sheet will be look like liabilities and liabilities 1,000, deferred charges, issuance cost capitalized, issuance charge capitalized 5 rupees, cash will be 1,000 minus 5, 995, 995 plus 5 is 1,000. In the IFRS balance sheet, liabilities 1,000 minus 5 issuance cost, 995 will be my liabilities, and cash will also be 995. Here deferred charge will be amortized to 0 over 5 years, every one for the 1 year. And here my liabilities will increase over time to pay 1,000. I have shown the 995 of liabilities on the issuance, but I need to pay 1,000 at the maturity, so my liability will be increased to 1,000 over time. 1 to 5 years. 5. Okay. Now let's understand the fair value reporting option. Bond liability report at the book value, which could be the same as the fair value if YTM is not changed since the issuance. If YTM is same, then the book value and face value will be the same. Fair value means market value, we have discussed up in the starting of the video. Under the US, in the both IFRS and US GAAP, there is an irrevocable option to report debt at the fair value. Irrevocable option means you could report your debt at the fair value, but you cannot get back to the old method after moving to the fair value. Then the gain or loss as a result of fair value reporting would be taken to the income statement, and the gain and loss will be transferred to income statement. Now let's talk about the recognition of the debt, paying back your debt bond. So for example, my in the balance sheet my liability is 900, and if I bought back the bond the 920, I will have the loss of 20 because my liability is only 900 in the books. So 20 rupees loss will be shown in the PNL, and if I buy at the 850, so I will show 50 rupees of income in the PNL. In the US GAAP, there is a slightly difference. For example, with the issuance cost, there is a slight difference. So for example, I have liabilities of 1000, 5 rupees of issuance cost. Over the year, I will reduce that issuance cost. At the year 2, I have issuance cost of 3 amount, and the bond liability is 1000. At the year 2, if I bought back the bond at 1070, okay, means I have paid the 70 rupees extra on my liabilities, and I also have the loss of these deferred charges, this issuance cost capitalized, so I need to write off these also. So my loss would be 70 plus these 3 also. Okay, and if I sell at the profit at 9, I bought at the profit at the 950, so 50 rupees on these liabilities minus 3 means 47 will be my profit. 73 plus 50, 47. Same as here, my liability will be shown at 995 only, not this bifurcation, and over time my liability will increase to 997. At year 2, I bought back the bond at 1070, so 73 rupees, um, 1070 minus 997, 73 will be my loss. And if I bought back at the 950, my 47 will be 997 minus 950, 47 will be my profit. So this is the explanation of the recognition of the debt. When bond liability is bought back, any unamortized liability in the US GAAP will increase the loss and decrease the profit. Here as explained here, it will impact your profit or loss. So this is the brief understanding of the bond liabilities. I will make these separate to for the lease and pension. Thank you for listening. Have a good day.